Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is currently 7:12 a.m. Central Time, and I'm recording this in preparation for the market day of January the 6th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive right in. We've had a number of significant changes in the last 24 hours, so I want to go right at our market timing opinions. While we are still in phase 3, bull flag, bull flat, with higher highs and higher lows, we have not yet put in a lower low. It is important to recognize that our portfolio trader posture has dropped to full-fledged market and correction. Now, we've had a divergence here in recent days, but as volume came back into the market, and indeed an interesting stat from yesterday, yesterday had 3.8 billion shares trading, closing in on the higher numbers of 4 billion, which are normally reserved for big plunges. So obviously volume is back, and indeed if you look at the last 3 trading days, the day before the holiday, the day after the holiday, and then of course the first Monday back when most participants were back, it's all very bearish, and certainly has been confirmed with large widespread distribution. So we are in market and correction. There's no longer a divergence here. Indeed, you'll see on the active trader market posture, no new intermediate term bullish trades, no new short term bullish trades is now called for. So our posture is clearly turned. In terms of the portfolio trader position sizing, as you would expect, very minimal, 0 to 25%, depending on how your current positions are acting. From a volatility expression, it would call for 50 to 75%, certainly a reduction. So both of our metrics on position sizing are calling for reduced position sizing. So some of the things you might be thinking about is protection. Whether that be covered calls, whether that be other portfolio hedges, whether that be reviewing all your stops, perhaps taking profits on positions that have hit significant profit levels. A number of things that can be done, but certainly when we're in this kind of posture, it calls for all hands on deck, review everything that's in your portfolio, and make appropriate decisions. Now, while we said all that, an awful lot of conditions are coming together to call for a bounce. And we would not be at all surprised if we were to see a bounce. So it's very important for those of you that are intraday traders to watch for momentum, watch for that market breadth. Indeed, our one-day outlook yesterday was very bullish. It's even more so now. 3-day outlook very bullish, and we are still in an intermediate term bull market. So while our postures have certainly turned bearish, and we're not looking to enter new positions, but rather to manage existing positions, we are having a number of intraday and short-term opportunities that are likely to present themselves. From a market forecast, all 4 indexes have turned bearish and have fallen below the upper zone. So that's where we get no new bullish trades, short-term or intermediate. So members, obviously, you can go to the market forecast report to get additional details on what those charts look like. Our hedge warning status, we are a full-fledged 1. In fact, we'll even call this a 1+ now. We have a market and correction status. Many of our volatility metrics have not necessarily fired, but that's because we are already elevated volatility. We kind of ticked up, not in a big splash, but rather we've ticked up volatility in a more gradual pattern this time, and probably again a circumstance of the fact that this was starting to develop while there was low market participation. So the VIX has been climbing, and certainly is coming into play. Let's see here. The next thing I'd make note of is obviously yesterday was a distribution day across all the different markets. We'll take a look at the volatility report and we'll see some of that. But so we're not necessarily counting distribution days anymore while the market's in correction, but we will look to see once our status upgrades what that count looks like. VIX phase, we're going to call it trending up now. Obviously, we had an intermediate term. VIX was falling, but now while the short term was going up, we're going to start saying this is more of a trending up with several repeated days in a row with the VIX climbing, where VIX is almost at a 20. So VIX is above the volatility window in which option income strategies are conducive, so it would not be recommended to enter new option income strategies in the current environment. Couple other things I wanted to draw attention to. Obviously, our market posture, a lot of damage has been done here, and you see both in the short and intermediate term, our market postures across the various sectors are all very, very weak. And indeed, note that we had, everything was down yesterday. Obviously, while healthcare, consumer staples were down less, and you see here, for example, utilities market posture is still the strongest of all the sectors. You're still losing money, so it's not a time to take a new position in utilities unless you're doing so in a value proposition and you think you're able to determine where that good value comes in and when to enter based on those kinds of criteria. Based on the kind of criteria that we use here, it is not yet time to enter. It's not safe to be entering new positions based on our criteria. Obviously, there are others who use more of a value proposition, a fundamental analysis kind of approach. We're more technical traders, and we certainly pay attention to the fundamentals, and we like it when they line up with our technical premise. But we start technical first. We look at the charts. What are they telling us now, and not necessarily what do we think will be happening months or years down the road based on a fundamental premise playing out. In terms of industry groups, the retail, railroads, transportation, internet, and healthcare are all still at the top. Those are the top 5. So something to keep in mind there. Couple other stats I wanted to share with you I thought was so kind of interesting in my morning reading. We've had 3 lower highs, lows, and closes. And this condition has consistently led to a bounce going into turnaround Tuesday. Oftentimes we see Tuesday be a bounce day. Indeed, 3 down days, a gap down, and a 10-day low have combined for a substantial upside edge in the past. So we are certainly, and you can see why I said very bullish on the 1 and 3 day. We're really set up historically for a bounce. Another stat, forward plus day, pullbacks that experience the worst day of the pullback are normally primed for a bounce. Other things of interest, as we went through December, individual investors became significantly more positive, skewing their portfolio allocations towards stocks and away from cash to the greatest extent since the year 2000. So you could see where there's a circumstance here where it's very easy to hurt the individual investor who keeps getting caught on the wrong side. Indeed, if you think about the last 2 pullbacks, very sharp, followed by V bottoms, and indeed within a couple days recapturing much of the fall. Very difficult for self-directed retail traders to be able to keep up with that. The tendency is to get stopped out and then to wait for the all clear to go back in, and by the time they go back in, the market's already recovered 75% of what it had lost. So they've had a net loss on that move, and very, very difficult circumstances we've had in recent weeks. So something to kind of keep in mind, especially as you look at what the posture of the individual investors were going into December, kind of all-time highs in terms of their positions in stock versus cash since the year 2000. It's also the fifth time in history that the Dow Jones Industrial Average reached a 52-week high the last week of the year, and then started New Year with 2 days of selling pressure, suggesting no rush for investors to put new money to work. So it really is kind of setting up. Now, that's small numbers. It's hard to make too much of that, but all four of the others lost more ground during the rest of January for an average of 4.3% at the trough. Also, our last statistic from the morning reading was this is the first time in history that the SPY fund, that more than 90% of its components were trading above the 10-day averages within the past week, and then now fewer than 10% of them are trading above the 10-day average. So you went from one extreme all the way down to the other extreme in the period of about 3 trading days. So really quite difficult to be nimble enough to be able to take all that into your trading. Now, those that are following Falcon Global and our reports and our trading premise has certainly seen our elevated hedge levels and seen many of these signs coming into play, so that certainly would be helpful to many of them. Now, market condition, certainly one of the things we've noticed in recent days and been talking about is this uptick of implied IV, and you notice that all four of the indices, whether you're talking ES, certainly the Russell, certainly the Dow, now in the upper third of their historical implied IV percentiles. Also, you notice in these last few days, while we had some quiet right there during the Christmas week with very little in terms of the number of standard deviation days across the four indices, you now see with the return of all market participants, significant uptick in volatility. We had more than 2 standard deviation days on 3 of the 4 indices yesterday. Unusual, the Russell was actually the relative strongest, and I spoke about this on the blog yesterday. If you take a look at today's blog page, you'll see our case study talks a little bit about this, so that might be worth taking a look at. In terms of overnight action, just a couple things to draw attention to. Relatively quiet in the indices. There was some initial weakness and then some recapture of that. Now, exception, crude oil continues to get pummeled, and net change down 1.9%, and also gold. So we continue to see these two commodity markets as the primary movers of late in the overnight. So this yesterday, definitely this big move in crude that we also had going into yesterday's trading action. Here again, back-to-back nights with big action on crude oil could absolutely have an influence on the market, and especially certain sectors. In terms of the overseas markets, notice that Japan down 3%, Hong Kong down 1%. China's been relatively strong. In fact, we have some exposure to China in our core portfolio in the equity room, and this is definitely holding up much better than many other emerging markets. Most of the emerging markets are very, very poor condition right now, not worthy of even much in-depth chart study. They're just not in a position for investment of capital from a long side. China has been something of an exception. And you also see United Kingdom, the FTSE down 1.2%. In terms of macroeconomic reports, important things that are happening in the U.S. market today, ISM manufacturing PMI. And then tomorrow What do we have coming up? Oh my, we do have some really big stuff. We do have the ADP non-farm employment change, kind of a precursor to Thursday's report. But most important, we have trade balance, and then the biggies, FOMC meeting minutes hitting in the afternoon. So that could absolutely move markets. So a number of macroeconomic reports tomorrow that could be changers of intraday trends. So keep that very much top of mind. So we've been a bit long today. Obviously, if you like what we're doing, if you like the information that you're getting here, we greatly appreciate your support in getting the word out. Like us on your social media platforms. Follow us. You can get more information off the website, www.falconglobaltraders.com. As always, 2-week free trials are available to any of our 3 live trading rooms. Equity and ETFs, options, and futures are the 3 rooms. Additional questions may be sent to us at support@falconglobaltraders.com. Disclaimers, hit the pause button if you want to read this in more depth. And as always, we greatly appreciate your support. Thank you very much from Falcon Global Traders.